Ladies and gentlemen, this is Paper to Atoms. It is January 16th, 2026, and I'm about to tell you something that should be mathematically impossible. We talked about the quiet pressure building under the silver market, the kind of pressure that does not make headlines until it detonates. We talked about the drying inventories in London. We talked about the rising premiums in Shanghai. We talked about the widening spread between spot, futures, and physical that every mainstream analyst kept pretending did not exist. And I told you that retail investors were getting restless. I told you that the volatility was artificial. I told you that the banks were overexposed. And I told you that the next move, the next real move, would not come from Wall Street or the central banks. It would come from the people, the retail stackers, the silent army. And you know what happened? They pulled the trigger. They pushed $922 million, nearly $1 billion, into silver ETFs in a single session. Not a week, not a month, a session. And here's the part that should scare the banks. The inflow did not stabilize the system. It stressed it. It strained it. It exposed the cracks we had been warning about for months. The price goosed upward. Liquidity thinned out. And for the first time in a long time, the paper market blinked. When inflows of that size hit an ETF, you would expect the authorized participants to arbitrage it instantly, create shares, hedge the position, deliver metal, smooth the spread. That's how the machine is supposed to operate. But this time the system hesitated. SLV showed tracking errors. PSLV saw a time lag in sourcing. COMEX futures spiked more than the underlying spot market. And the banks, JP Morgan, HSBC, Bank of America, the same institutions that usually suppress volatility, suddenly found themselves on the defensive. Yesterday was the warning shot. Today is the escalation. The pressure has moved from the edges of the system to the center, and the people who caused it did not even realize the power they unleashed. Here's the truth. The development we are seeing right now is not subtle. It is not gradual. It is not the result of normal market forces quietly doing their job in the background. It is a rupture. Retail investors dumped $922 million into silver ETFs in one day. And the system could not absorb it cleanly. And let me be absolutely clear. The same ETFs that are supposed to provide liquidity, the same custodians that are supposed to source metal effortlessly, the same authorized participants that are supposed to create shares instantly, all of them stumbled. The same machine, the same mechanism, the same process, and yet completely different results. In a functioning market, this is impossible. It is impossible because ETF inflows should be neutral to the system. Buy shares, create shares, hedge futures, done. It should not create tracking gaps. It should not distort spreads. It should not trigger margin stress on the futures side. And it absolutely should not force banks to scramble for hedges like they are trapped in a burning building. Yet that is exactly what happened. And I am going to prove it to you. With numbers, with data, with evidence that even the most skeptical person cannot deny. Evidence showing the stress fractures forming underneath the surface, the friction between paper and physical, and the widening disconnect between what the charts show and what the vaults contain. Because right now, the pressure is not just rising, it is compounding. And the people causing it have no idea the storm they have unleashed. So buckle up, focus. Let me show you exactly what happened and why the banks are terrified. Let me start with the numbers because numbers do not lie. Politicians lie, bankers lie, the media lies, but mathematics is truth. So let's walk through the last 48 hours. Slowly, clearly, and with precision. Because what happened should not be possible in a stable, well-supplied liquid market. Yesterday's data, January 15th, 2026. SLV inflows, 154 million PSLV. Inflows, 62 million COMEX open interest change. 4 to 900 contracts. LBMA vault holdings, down 1.7 million ounces week over week. Spot silver price, 27.84. COMEX futures, front month, 28.11. Shanghai, premium, 0.44. Retail premium, US 1 Oz rounds, 3.49 over spot. That was yesterday's picture. Heavy inflows, tightening inventories, modest premiums, and a normal, but growing, spread between spot and futures. Now watch how everything mutated violently in just 24 hours. Today's data, January 16th, 2026. SLV inflows, $738 million. PSLV inflows, $184 million. Total inflows, $922 million. COMEX open interest change, 1,213 on 200 contracts, highest one-day surge in 9 months. LBMA vault holdings, down another 900,000 ounces intraday reporting. Spot silver price, 29.57. COMEX futures, front month, but 30.22. Shanghai premium, it's 1.18. Retail premium, US 1 Aussie rounds, 4.65 over spot. Let me say that again so it sinks in. $922 million flowed into silver ETFs in a single session. And instead of stabilizing the market, the inflows triggered dislocations across every major price reference. That is not normal. That is not stable. That is not efficient market behavior. Let's calculate the spread right now. Spot versus COMEX futures. Spread $30.22, $29.57, 0.65. Yesterday's spread $28.11, $27.84, and $0.27. The spread more than doubled in 24 hours. Let me say that again. The spread more than doubled in 24 hours. That is a 140% increase in the futures premium overnight. This only happens when the futures market is under stress, not normal stress, margin stress, hedging stress, liquidity stress. This is the exact pattern you see when banks scramble for hedges, because they cannot T-source metal fast enough in the physical market to balance their exposure. Shanghai isn't just elevated, it is flashing red. Yesterday, 0.44 premium. Today, it's 1.18 premium. That is a 168% jump in 24 hours. But here's the critical part. Shanghai premiums usually narrow when Western ETFs experience heavy inflows. Because authorized participants arbitrage the difference by shifting metal where the demand is highest. But this time, the premium widened. That means the metal did not move. That means the arbitrage didn't happen. That means something is blocking the flow. Either the metal isn't available, or the cost to move it is too high, or the banks don't want to lose what little inventory they have left. Pick whichever explanation you prefer. None of them are good. Retail premiums have now broken above the $4.50 threshold for common 1-ounce rounds. This is what the chart should look like. Normal premium, $179, $249. Elevated premium, $275, $325. Stress premium, $350, $4. Panic premium, $465 and climbing. We are now firmly in panic premium territory, even though spot is still under $30. Why? Because retail dealers cannot restock fast enough, because wholesalers are on allocation, because refiners are on backorder, and because the flow from COMEX to London to retail channels is lagging by weeks, not days. This is the moment where paper price and physical price stop agreeing with each other. Let me put these numbers in historical context so you understand how serious this is. 1980, silver spike. When silver exploded to $50, premiums rose 80 to 100%. 2008, financial crisis, premiums surged 40-70% while spot lagged. 2011, Silver Sunday premiums hit 60% during the CME margin hikes. Today, we are seeing a premium spike of 67% on 1-ounce rounds, while spot is still in the high 20s. That is unprecedented. That is structural. That is a sign of real tightness, not speculative tightness. Let me summarize this with a simple triplet. The inflows have happened. The spreads have blown out. The premiums have detonated. This is not a temporary blip. This is not a one-off anomaly. This is not a speculative spike that fades in a week. This is system stress. Banks are hedging aggressively. ETFs are struggling to track underlying metal. LBMA inventories are draining faster than they can be replenished. And most importantly, the paper market is moving one way. The physical market is moving another. And the gap between them is widening. Fast. When these conditions appear together, inflow surge, premium spike, spread widening, inventory decline. It is the exact same pattern that precedes every major silver market disruption of the last 50 years. The machine is no longer humming. It is rattling, grinding, overheating. And retail just threw $922 million into the gears. Now, let me put this in perspective because I do not want you to think I'm exaggerating. What we are witnessing right now is not just unusual. It is unprecedented. And I do not use that word lightly. There have been moments of stress in the silver market before. 1973 had geopolitical panic. 1980 had the Hunt brothers squeeze. 2008 had a liquidity crisis. 2011 had a coordinated margin attack. But none of those events combined all the elements we are seeing simultaneously right now. Not stress in one area, not strain in two areas, but stress, strain, and structural failure across all of them at the same time. In a normal market, ETF inflows should smooth volatility. In a normal market, futures premiums should compress when spot rises. In a normal market, Shanghai premiums should narrow when Western liquidity increases. In a normal market, retail market premiums should rise slowly and stabilize. But today, every one of those mechanisms is doing the exact opposite of what it is designed to do. The arbitrage is dead. Not difficult, not inconvenient, dead. Let me explain why. Arbitrage only works when metal is freely available, cheaply transportable, and quickly deliverable. That requires three conditions: available inventory, low transportation costs, and confidence that the futures market will settle without incident. Right now, all three conditions are compromised. Ask yourself this. Can we not ship metal from London to New York? Of course we can. That's not the problem. Can we not convert 1,000 Oz wholesale bars into retail units? Of course we can. That's not the problem. Can we not create ETF shares through authorized participants? Absolutely. That's still mechanically possible. So again, that's not the problem. The problem is that every step in that supply chain is moving slower, costlier, and more dangerously than the banks want to admit. Start with inventories. LBMA holdings have been draining steadily for months, long before this week's surge. Over 2.6 million ounces disappeared in the last 6 days alone. That is not accidental. That is not seasonal. That is not normal. That is withdrawal. Strategic withdrawal. Inventories that should be replenished are instead shrinking, and nobody is explaining why. Then we have transportation costs. Moving silver internationally is not like moving a pallet of iPhones. It requires armored logistics, customs clearance, insurance, security, and coordination between vaults. When demand spikes across multiple regions at once, the costs explode. When the cost to move metal exceeds the arbitrage profit, the arbitrage stops. And that is exactly what we are seeing today. But the most critical issue is confidence, or rather the lack of confidence, in futures settlement. Banks hedge their ETF inflows using futures. But if they fear that delivery might become difficult, delayed, or contested, the hedge becomes riskier. So they hedge more aggressively, they widen their spreads, they buy additional contracts, they push volatility higher. And that is how you get a market where rising ETF inflows cause rising premiums instead of dampening them. This is why what you're witnessing is unprecedented. All the safety valves are failing at the same time. There is no release mechanism, there is no pressure relief, everything is bottling up in the physical market while the paper market pretends to be calm. We have seen this pattern before, but always in isolated form. In 1973, it was geopolitical. In 1980, it was manipulation. In 2008, it was liquidity. In 2011, it was margin enforcement. But today, it is geopolitical, manipulative, liquidity-based, and margin-driven all at once. A forefront assault on stability. And here's the part everyone is missing. This is not happening because of institutional positioning. This is happening because retail detonated $1 billion inflow in one day, and the system simply was not prepared for it. Think about that. A single day of inflows, not a hedge fund, not a sovereign fund, not a central bank, but everyday people buying ETFs created a chain reaction that knocked the paper market off balance. That is the part the banks don't want to talk about. That is the part the analysts keep ignoring. That is the part the mainstream media will pretend does not exist. And yet, here we are. The futures market is strained. The physical market is tightening. The arbitrage channels are blocked. The machine designed to suppress volatility is now amplifying it. This is why I say this moment is unprecedented, because in the past, when the system showed stress, it was always controllable. The CME could raise margins, banks could short futures, ETFs could issue new shares, London could shift metal east or west. There were always levers to pull, but now the levers aren't working. Or worse, the levers are making things more chaotic, and this is where it gets really interesting. The banks can simply flood the market with paper shorts, because that increases their exposure if physical delivery becomes strained. They can easily dump inventory because they don't have enough spare metal to do it safely. They can rely on the usual playbook because retail demand is coming from three directions at once: ETFs, physical coins, and industrial buyers. The situation is no longer linear. It is nonlinear. It is compounding. It is accelerating. And the banks know it. This is not exaggeration. This is not hype. This is not guesswork. This is structural breakdown happening in real time. And it is happening faster than the system can compensate for. Now, let me tell you what happened this morning that makes today's move even more significant. Because the banks didn't just sit back and watch retail pour nearly $1 billion into silver ETFs. No. They reacted instantly. They hit the panic button. And their response tells you everything you need to know about how fragile the system truly is. At 7:42 a.m. Eastern, before the U.S. markets officially opened, the CME quietly issued a margin advisory update. Not a headline announcement, not a press release, a buried notice. They raised initial margin requirements on silver futures contracts by 11% and maintenance margin by 9%. That is a direct attempt to choke leverage and force weaker longs out of the market. They did this specifically to slow the inflows. They did this specifically to discourage speculative buying. They did this specifically to protect the banks who are short. And for about 45 minutes, it looked like it might work. Futures volume dipped. High-frequency trading algorithms pulled back. The price paused under 29.80, sitting there like a car stalled on a hill. But then something happened. Something the CME did not expect. Instead of longs liquidating, more buyers stepped in. Retail kept buying. Asian traders piled in. European funds, who normally sit on the sidelines, joined the surge. The margin hike backfired. Rather than scaring buyers away, it signaled that the banks were terrified, and nothing attracts buyers more than the smell of fear. The CME has used this tactic before. In 2011, they raised margins 5 times in 8 days to crush the Silver Sunday rally. It worked back then because that rally was fueled by leveraged futures traders, not physical stackers. Today, the buyers are not hedge funds borrowing money. They are people buying with cash, ETF inflows, physical borrowers, sovereign mints, industrial consumers. You can't margin call someone who isn't using leverage. And once the CME realized their first move failed, the next villain got involved. At 9:15 a.m. Eastern, JP Morgan, historically the largest short player in the silver market, widened their bid-ask spreads across the COMEX trading desk. That us to S bank speak for we don't want to be on the hook for sudden volatility. They pulled liquidity. They delayed fills. They made it harder for anyone to execute trades without paying a higher cost. They did this specifically to slow the momentum. They did this specifically to defend their short positions. They did this specifically to buy themselves time. But again, it didn't work. The spread widening only created more panic in the market-making machinery and more suspicion among traders. Volatility increased, limit orders slipped, mini-contract activity surged, and then HSBC joined the party. Around 11:20 a.m., their metals desk initiated a coordinated block of short sales intended to cap the price under $30. This is the same tactic they used in 2020 during the liquidity crunch. A huge wave of synthetic shorts to overpower buying pressure. But guess what? They didn't have the inventory to back it up this time. And traders noticed. The shorts weren't getting traction. Instead of dragging the price down, the banks got steamrolled. The synthetic supply they attempted to create was swallowed instantly by real demand. They were trying to push down a spring that was already compressed to the breaking point. That's when the real panic began. By noon, COMEX futures volatility spiked so sharply that internal circuit breakers nearly tripped. The last time this happened in silver? March 2020, during one of the worst liquidity collapses in modern history. And then the final blow landed. The vault reports. The midday report showed unexplained outflows from both JP Morgan and Brink's COMEX vaults, a combined 740,000 ounces. That is not normal. Vault outflows during rising prices are one of the biggest red flags you can possibly see. It means the banks are not adding inventory. They are losing it. Put it all together. The CME raised margins. JP Morgan widened spreads. HSBC dumped synthetic shorts. Vaults showed massive outflows. All attempts to suppress the price. All attempts to protect themselves. All attempts to regain control of the market. And every single one of those attempts failed. This is the defining moment. The manipulators are pushing harder than they have in years. And yet the price keeps rising. The demand keeps climbing. The premiums keep expanding. The villain's move has been made, and the villain's move has failed. The time for debate is over. The time for watching is over. The system, the paper market, the ETFs, the leveraged futures is dying. The truth on the physical market, the deliverable metal, the reality in your hands is taking over. You are holding the collateral of the New World Order. Every ounce you stack, every coin you secure, every bar you hold is more than an investment. It is protection. It is leverage against a system that has been running on promises and paper for far too long. Do not sell. Do not let them steal your silver. Do not let them shake you out of what you know is real. The target is $42.57, and the timeline is accelerating. The fundamentals, inventory declines, inflows, premiums, global industrial demand are undeniable. This is not speculation. This is math, physics, and reality converging. The $922 million inflow today is only the beginning. It is the warning, the spark, the signal that the system cannot contain itself any longer. And you have the opportunity to act, to protect, to position yourself before the chaos reaches its peak. This is Paper to Atoms. If this video opened your eyes to what's really happening in the precious metals market, do me a favor right now. Hit that subscribe button and smash the bell icon so you never miss an urgent update like this. The information I share on this channel could be the difference between protecting your wealth and losing everything to the paper market collapse. Like this video, if you're holding physical and you're not selling, share it with anyone you know who needs to understand what's coming. The mainstream media won't tell you this. Your financial advisor won't tell you this. But I will every single day. On Paper to Atoms. And here's a question for you. Leave it in the comments below. Are you holding physical or paper? Let me know in the comments. What price do you think silver hits by March 2026? Comment your prediction. Have you tried to buy physical recently? Tell me about the premiums you're seeing. Do you think the banks will survive this squeeze? I read every single comment, and I'll see you in the next update. Remember, get out of paper. Get into physical. Go, go, go.